Good day. Once again, I'm Teacher Lei. Previously, we have discussed how domestic corporations are taxed. Now, we're going to discuss tax on domestic corporations. For the overview of the chapter, we're going to define resident corporations, taxability of resident corporations, the income tax rules on resident corporations, particularly capital gains taxation, final tax, normal tax, minimum corporate income tax, and the profit remittance tax. Let's first define resident corporations. When we say resident corporations, these are corporations organized under foreign laws, and they are authorized by Philippine regulatory agencies to do business in the Philippines. For resident corporations, there are also three categories of income: capital gains, passive income, and active or regular income. When we say capital gains, these are gain on sale, exchange, or disposition of capital assets. Take note that we have discussed in a previous chapter that there are two different types of assets: ordinary assets and capital assets. Ordinary assets are assets that are used in the normal course of the business, while capital assets are assets that are held for investments. Examples are gain on sales of shares of stocks, gain on sale of bonds, gain on sale of real property. The second category of income is the passive income, which is an income earned with very minimal or even without active involvement of the taxpayer in the earning process. Examples are interest income, dividends, and royalties. The third category of income where resident corporations are taxed is the active or regular income, which is an income that requires active involvement of the taxpayer. Example is the business income earned by resident corporations. Take note that the three categories of income, capital gains, passive income, and active or regular income, are subject to three income taxation schemes: capital gains tax, final income taxation, and corporate income taxation. There are capital gains that are subject to capital gains tax, while other capital gains are subject to corporate income taxation. Also, with passive income, there are some passive income that are subject to final income taxation scheme, and others are subject to corporate income taxation, while the active or regular income is subject to corporate income taxation. Take note that not all capital gains are subject to capital gains tax. Not all passive income is subject to final tax. The other income, or the active or regular income, is subject to corporate income tax. Meaning there are capital gains or passive income that are subject to corporate income tax, like for example, interest on notes receivable, capital gains on sale of shares of stocks of a resident corporation. Let's first discuss capital gains taxation. Just like domestic corporations, resident corporations' sale of shares of stocks of a domestic corporation not listed or traded in the local stock exchange held as capital asset is subject to the final tax of 15% based on net capital gain, which can be derived by deducting costs from the selling price. Take note that there is only a tax if the sale resulted in a gain. If there is a loss, then there is no capital gains tax. In here, the resident corporation is selling shares of stocks of a domestic corporation. For capital gains taxation, the tax is due within 30 days from the date of sale. For final income taxation, just like the domestic corporations, the passive income, particularly interest under the expanded foreign currency deposit system, is subject to final tax of 7.5%. In domestic corporations, Interest under the expanded foreign currency deposit system is subject to final tax of 15%, but for resident corporations, they are subject to final tax of 7.5%. For interest income from deposits, whether short-term or long-term, or whether any currency, deposit substitutes, trust fund, or royalty, they are subject to final tax of 20%, just like domestic corporations. And dividend earned by resident corporations from domestic corporations, or what we call intercompany dividend, is also exempt. So take note that the tax is withheld at source, meaning the income received is already tax paid. Well, unlike domestic corporations, where domestic corporations are taxed on passive income earned within and outside the Philippines, resident corporations are taxed on passive income from sources within the Philippines only. Any passive income earned outside the Philippines are not taxed in the Philippines. That is under the territoriality concept in our previous discussion under general principles of taxation. For corporate income taxation, we have discussed that income tax rules for domestic corporations are either the normal tax or the minimum corporate income tax. Just like domestic corporations, resident corporations are also taxed with the same rules. For 0 to 3 years of operation, there will be a normal tax of 30% based on taxable income. But beginning the fourth year of operation, we will compare normal tax of 30% based on taxable income and the minimum corporate income tax of 2% based on gross income, and whichever is higher will be paid as the income tax or the year's tax. For the normal tax, let's review our formula. Gross income less itemized deduction, which are the expenses or losses of the business, or the optional standard deduction of 40% based on gross income. And that will become the taxable income, and multiply it with the income tax rate of 30% to get the normal income tax. For minimum corporate income tax, the formula is gross income times tax rate of 2% to get the minimum corporate income tax. Take note that gross income includes gross profit from sales, or it also includes those passive income that are not subject to final income tax, and those capital gains that are not subject to capital gains tax. Take note that resident corporations are taxed on income from all sources within the Philippines only, unlike domestic corporations, which are taxed on income within and outside the Philippines. So resident corporations are taxed on income from all sources within the Philippines only. Any income earned outside the Philippines are ignored under Philippine income taxation. Now let's have an illustration. Alexia Joy Incorporated is a resident corporation. In 2019, in its first year of operations, it had the following data on income and expenses. Gross income from within the Philippines of 580,000, gross income from outside the Philippines of 650,000, expenses on income from within the Philippines 340,000, expenses on income from outside the Philippines of 420,000. How much is the income tax for the year? So we will compute for the income tax. Take note that resident corporations are taxable only within the Philippines. Any income and expenses in the Philippines are considered, and those that are outside the Philippines will be ignored. Thus, gross income from the Philippines will be considered. Gross income from outside the Philippines will not be considered. Expenses on income from within the Philippines is considered, and expenses on income from outside the Philippines will not be considered. So, our solution will be gross income from within the Philippines of 580,000 less expenses on income from within the Philippines of 340,000, and that will make you arrive at taxable income from within the Philippines of 240,000. Since it is the first year of operation, we will compute for the normal tax only of 30%. So multiplying 30% with the taxable income from within the Philippines of 240,000, we will arrive at the income tax for the year of 72,000. So our answer for this illustration is 72,000. Let's have another illustration. This time, Andre Jayus Company. Andre Jayus Company is a resident corporation in its 5th year of operations in the Philippines in 2019. It has net sales, cost of sales, and business expenses both in Philippines and abroad. Take note that resident corporations are only taxed in the Philippines for its income earned within the Philippines only. So how much is the Philippine income tax for the year? So we'll consider only the Philippine income and expenses and not the foreign income and expenses. So our solution will be net sales of 4 million less cost of sales of 1,200,000 is equal to the gross profit from sales of 2,800,000. Then we deduct the business expenses amounting to 2 million to get taxable income of 800,000. Since it is already in its 5th year of operations, we will compare normal tax at 30% of taxable income and the minimum corporate income tax at 2% of gross income. First, let's determine the normal tax at 30%. 30% times the taxable income of 800,000, we will arrive at 240,000. For the minimum corporate income tax, that is 2% of gross income, so 2% times the gross income of 2,800,000, and we will arrive at 56,000. Then we will compare normal tax and minimum corporate income tax. Whichever is higher will be the income tax of the year. In this case, normal tax of 240,000 is higher. So this is the income tax for the year. Take note that resident corporations are also filing quarterly and year-end income tax returns. So the rules on quarterly and year-end income tax returns of domestic corporations also apply to resident corporations. Another tax applicable to resident corporations is the profit remittance tax. This is any profit remitted by a branch to its head office, and it shall be subject to final tax of 15%, which shall be based on the total profit applied or earmarked for remittance without any deduction for the tax component thereof, except those activities which are registered with the Philippine Economic Zone Authority, or what we call PEZA. Let's have an illustration. Let's say that a branch office of a resident corporation applied through the Philippine banking system for a remittance to its mother company abroad of 500,000 from its profits from Philippine operations. How much is the profit remittance tax? How much is the remitted amount net of tax to the mother company? So let us solve. First, let's solve for the profit remittance tax. So profit earmarked for remittance based on the problem amounts to 500, and the tax rate or the profit remittance tax rate is 15%. So profit earmarked for remittance of 500,000 times the tax rate of 15% will make you arrive at the profit remittance tax of 75,000. So our answer for the first question is 75,000. Now for the next question, how much is the remitted amount net of tax to the mother company? So our formula will be profit earmarked for remittance less profit remittance tax will be the remittance to its mother company. Take note that the profit earmarked for remittance amounts to 500,000. Then deduct the profit remittance tax which we have computed previously at 75,000. Therefore, the remittance to the mother company net of tax will be 425,000. And that is our answer for the second question. Let's have another illustration. This time, we have Althea J-Cell Corporation. Althea J-Cell Corporation is a foreign corporation authorized to do business in the Philippines by Philippine regulatory agencies and had the following data from its second year of operations in 2019. It has gross income from Philippines of 30 million, gross income from foreign sources of 90 million, business expenses in the Philippines of 10 million, and business expenses from foreign sources of 40 million. Out of the Philippine income, there was an actual remittance abroad of 8,500,000. How much is the Philippine income tax on income from operations? And how much is the profit remittance tax paid? Take note again that resident corporations are taxed on income within the Philippines only. Any income earned outside the Philippines will be ignored. So we will consider gross income from the Philippines, the gross income from foreign, and the business expenses in the Philippines, I should say, will be considered, and the gross income from foreign sources and business expenses from foreign sources will be ignored. Thus, let's compute for the Philippine income tax. So gross income from the Philippines of 30 million, less business expenses in the Philippines of 10 million, we will arrive at a taxable income of 20 million times the normal tax rate of 30%. So the income tax for the year will be 6 million. Take note that Althea J-Cell Corporation is in its second year of operations. So it will be the normal tax only that will be computed. So our answer for the question number 1, or the first question, is 6 million. Now for the second question, how much is the profit remittance tax paid? So our formula will be profit earmarked for remittance less profit remittance tax equals remittance net of tax. Take note that the 8,500,000 in the problem is already net of the profit remittance tax because this is already the amount that was actually remitted abroad. So this is the amount received by its head office or the mother company. So this is already the remittance net of tax. And we are looking for the profit remittance tax, which is 50% of the profit earmarked for remittance. So since this is the unknown, profit earmarked for remittance is also unknown, and profit remittance tax of 15% is based on the profit earmarked for remittance, then we can say that the profit remittance tax is 15% of profit earmarked for remittance, which is equivalent to 100%. Therefore, the remittance net of tax is 85%, meaning the 8,500,000 is equivalent to 85% of the profit earmarked for remittance. So to get the profit earmarked for remittance first, we will divide 8,500,000 by 85%. So, 8 million divided by 85% is equal to 10 million. And this is the profit earmarked for remittance. Then we multiply it by 15% to get the profit remittance tax of 1,500,000. The second question is asking for the profit remittance tax paid. So our answer will be 1,500,000. So that is how resident corporations are taxed. For the references, we have the book from Banggawan, Income Taxation Laws, Principles and Applications, and the book by Virgilio Reyes, A Study on Income Tax Law and Accounting under the Train Law 2019 edition. So this ends chapter 4. I hope that you will subscribe to my YouTube channel, Teacher Lay. Good day and God bless.